Blimey, we have no fewer than 116 scheduled corporate announcements coming up this week, including 30 from FTSE 100 constituents alone. So we're all going to be very busy. So busy, in fact, I'm going to gloss over the macro stuff, other than to say, watch out for the latest policy meeting at the US Federal Reserve on Thursday the 26th of July. After two hikes of 0.25% each this year, the American Central Bank's expected to sit on its hands this time. But watch for any comment on when it may begin to withdraw quantitative easing. The market's best guess for the next rate hike, by the way, is December. Now, on to the companies. Among that deluge of company news, analysts and your fellow investors will be paying particular attention to the following. First half results from Reckitt Benckiser and full year figures from Sky on Monday the 24th. Interim results from GlaxoSmithKline and ITV on the 26th. First half figures from AstraZeneca, Diageo, Lloyds and Shell on Thursday the 27th. And finally, first quarter numbers from beleaguered telco BT on the 28th. But for all of that lot, I suspect that the stock most capable of causing a fuss in the week ahead is Barclays, which is due to report first half figures on Friday the 28th of July. The bank sector has been doing well. This chart here shows the grouping against the FTSE All Share over the past 12 months, and as we can see, they've beaten the headline index hands down. Barclays was initially a front runner in that charge, but as we can see in the second graphic, the shares have rather lost momentum of late. Now, there look to be a number of factors at work here and reasons for that underperformance. First, no one is any the wiser as to whether Brexit will be good, bad or neutral for the UK economy. Second, interest rates are still anchored at record lows and this potentially hurts the bank's net interest margin. And third, concerns are gathering that the UK still has too much debt and that consumers' use of credit is starting to run too hot, raising the spectre of bad loan losses further down the road. Finally, Barclays' reputation is still suffering. Chief Executive Jez Staley got himself in an unseemly dispute over a whistleblower, while one of his predecessors as boss, John Varley, is now in court amid allegations of fraud over how the bank raised money from Qatar all the way back in 2008. Note that Barclays PLC, not the bank, has also been charged, which could mean more fines from the regulator, though the case isn't going to be heard until 2019. Now, in the long run, the men or women at the top set the tone. And if the culture's not right, this could affect a company's operation and financial performance in the end. In fact, it probably will. It may also mean investors pay a lower multiple or demand a higher dividend to compensate for themselves for these management risks and cultural risks. Anyway, the first half figures are Barclays' chance to show that its performance is improving. In terms of the headline pre-tax profit number, Barclays earned £2.1 billion a year ago, and that's your benchmark for the first 6 months. Note, however, the headline figure was flattered by £800 million of capital gains and punctured by £1.4 billion of restructuring, loan impairment and conduct costs, so the underlying figure for comparison is 2.7. Do keep an eye on those three negative figures, which include PPI charges. The next chart shows how they've added up by quarter since 2013, costs, litigation, loan losses. If, and I stress if, Barclays can keep those ugly numbers down, then profits could advance very smartly, and that's the bull case for the stock, especially if it can also continue to sweat down its balance sheet and get rid of the assets it doesn't want. That should reduce risk. Remember that alongside the full year figures in February, boss Jez Staley announced that the bad bank, which last year lost $1.8 billion and had assets of $32 billion, on 9% of group total, would be wound down by June. That was earlier than planned, so let's look for an update there. While getting rid of the bad bank would be a good thing, it does also show how Barclays is effectively shrinking rather than growing itself back to health, although management remains wedded to the cyclical investment banking business as a potential source of growth. Loan growth, deposit growth have been nothing to shout about for some time, while risk-weighted assets on the balance sheet are still shrinking too, as we can see here going back to the first quarter of 2014. That said, at least the rate of momentum does seem to be improving a little bit. Also look to see how these trends have developed in Q2, but it seems likely that the bulk of future profit progress will come from less bad stuff happening rather than loan and deposit growth. Now that's fairly low quality, low multiple stuff, and Barclays' dividend yield may need to start growing again to give some real oomph to the shares. This is the dividend history going back 10 years, and as we can see, the bank paid 3p a share last year, a penny in the first half and tuppence in the second. Analysts are expecting a small increase to 3.2p for the full year, so let's see if the interim payment is nudged higher. Thank you for watching, and I look forward to seeing you next time.